The last moment or two of this and take you live to Elizabeth Warren, the senator from Massachusetts, speaking at the U.S. Capitol in the Russ Hall Senate office building. She's speaking to a group called the Americans for Financial Reform and the Roosevelt Institute. It's just getting underway live here on C-SPAN 2.
We fought shoulder to shoulder throughout the Dodd-Frank efforts, and after that in the regulatory efforts, and continue that battle today. So I want to start this by saying a very big thank you to Americans for Financial Reform and to the Roosevelt Institute for inviting me to speak here today. I've been working very closely with AFR and with Roosevelt, and I am delighted to be here. You know, it has been 5 years since the financial crisis, but we all remember its darkest days. Credit dried up, the stock market crashed, historic institutions like Lehman Brothers and Merrill Lynch were wiped out. There were legitimate fears that our economy was tumbling over a cliff and we were heading into another Great Depression. We averted that grim outcome, but the damage was staggering. A recent report by the Federal Reserve of Dallas estimated that the financial crisis cost us upwards, are you ready? Cost us upwards of $14 trillion. That's trillion with a T. That's $120,000 for every American household. More than 2 years of worth of income for the average family. Billions of dollars in retirement savings disappeared. Millions of workers lost their job and their sense of financial security. Entire communities were devastated. And a new Census Bureau study shows that just a couple of months ago came out showing that homeownership rates for families with young children have declined by 15%. The crash of 2008 changed lives forever. In April 2011, after a 2-year bipartisan inquiry, the Senate's Permanent Subcommittee on Investigations released a 635-page report that identified the primary factors that led to the crisis. The list included high-risk mortgage lending, inaccurate credit ratings, exotic financial products, and, to top it all off, the repeated failure of regulators to stop the madness. As Senator Tom Coburn, the subcommittee's ranking member, said, blame for this mess lies everywhere from federal regulators who cast a blind eye, Wall Street bankers who let greed run wild, and members of Congress who failed to provide oversight. Even Jamie Dimon, the CEO of J.P. Morgan Chase, has emphasized that inadequate regulation was a source of the crisis. He wrote this to his shareholders. Had there been stronger standards in the mortgage markets, one huge cause of the recent crisis might have been avoided. The crash happened quickly and dramatically, and it caught our nation and apparently even our regulators by surprise. But don't let that fool you. The causes of the crisis were years in the making, and the warning signs were everywhere. As many of you know, I spent my career studying the growing economic pressures on middle-class families, families that worked hard and played by the rules and still can't get ahead. And I've also studied the financial services industry and how it's developed over time. A generation ago, the price of financial services, credit cards, checking accounts, mortgages, signature loans, was pretty easy to see. Both borrowers and lenders understood the basic terms of the deal. But by the time the financial crisis hit, a different form of pricing had emerged. Lenders began to use low advertised prices on the front end to entice their customers in. Lenders began to use low advertised prices on the front end to entice their customers in. Lenders began to use low advertised prices on the front end to entice their customers in, and then made their real money with fees and charges and penalties and repricing back in the fine print. Buyers became less and less able to evaluate the risks of a financial product. Comparison shopping became almost impossible, and the market became less efficient. Credit card companies took the lead, with their contracts ballooning from a page and a half back in 1980 to more than 30 pages by the beginning of the 2000s, and teaser rate credit cards that advertised these deceptively low interest rates paved the way for teaser rate mortgages. Now, when I worked to set up the Consumer Financial Protection Bureau, I pushed hard for steps that would increase transparency in the marketplace. The crisis began one lousy mortgage at a time, and there's a lot we must do to make sure there are never again so many lousy mortgages. The CFPB made some important steps in the right direction, and I think we're a lot safer now than we were then. But what about the other causes of the crisis? There's no question that Dodd-Frank was a strong bill, the strongest in 3 generations. I didn't have a chance to vote for it because I wasn't in the Senate yet, but if I'd had the chance, I would have voted for it twice. I would have. But the law is not perfect, and so it's important to ask, where are we now, 5 years after the crisis hit and 3 years after Dodd-Frank? Now, I know there's been a lot of discussion today about a variety of issues, but I want to focus on one in particular. Where are we now on too big to fail? Where are we on making sure that the behemoth institutions on Wall Street can't bring down the economy with a wild gamble? Where are we on ending a system that lets investors and CEOs scoop up all the profits in good times and then stick the taxpayer with the losses when things go wrong? You know, after the crisis, there was a lot of discussion about how too big to fail distorted the marketplace, creating lower borrowing costs for the largest institutions and a competitive disadvantage for the smaller ones. There was a lot of talk about moral hazard and the dangers of big banks getting a free, unwritten, government-guaranteed insurance policy. Sure, there was talk, but look what happened. Today, the 4 biggest banks are 30% larger than they were just 5 years ago. And the 5 largest banks hold more than half of all the total banking assets in the country. One study earlier this year showed that the too big to fail status is giving the 10 biggest U.S. banks an annual taxpayer subsidy of $83 billion. Wow, who would have thought 5 years after the crisis that we witnessed firsthand the dangers of an overly concentrated financial system, that the too big to fail problem would only have gotten worse? Now, there are many who say, sure, too big to fail isn't over yet, but Congress should wait to act further until the agencies have had a chance to issue a lot of the Dodd-Frank required regulations. And it's true. There are still rules left to be written, and that's because the agencies have missed more than 60% of their statutory deadlines. Now, I don't understand this logic. Since when does Congress set deadlines, which regulators then miss most of them, and then take that failure as a reason not to act? I thought that if the regulators failed, it was time for Congress to step in. That's what oversight means, and that's certainly a principle that would have saved our country during the financial crisis. So let's put the pieces together. Think of these 2 things. It has been 3 years since Dodd-Frank was passed, and the biggest banks are bigger than ever. The risk to the system has grown, and the market distortions have continued. And second, while the consumer agency has met every single statutory deadline, so we know it's possible to get, while the consumer agency has met every single statutory deadline, so we know it's possible to get the job done. The other regulators have missed their deadlines and not given us much reason for confidence. The result is that the too big to fail problem remains. Now, I add that up and it's clear to me. I think it's time to act. The last thing we should do is wait for another crisis, for another London whale or another LIBOR disgrace or another robo-signing scandal before we take action. For that reason, I partnered with Senators John McCain, Maria Cantwell, and Angus King to offer one potential way to address the too big to fail problem, the 21st Century Glass-Steagall Act. By separating traditional depository institutions from the riskier financial institutions, the 1933 version of Glass-Steagall laid the groundwork for half a century of financial stability. But throughout the 1980s and 1990s, Congress and the regulators chipped away at Glass-Steagall's protection, encouraging the growth of the mega banks and a sharp increase in systemic risk. They finally finished that task with the 1999 passage of Gramm-Leach-Bliley, which eliminated Glass-Steagall's protections altogether. So the 21st Century Glass-Steagall Act would reinstate many of the protections found in the original Glass-Steagall Act. It would wall off depository institutions from riskier activities like investment banking, swaps dealing, and private equity activities.